And good evening. This is Mottek On Money, number one for your business and consumer news here on 790 KABC. I'm Frank Mottek. We are doing it live right here, weeknights in the 5 o'clock hour in Los Angeles, in the heart of drive time. Mottek On Money, 5 nights a week for you, live on the air here in 790 KABC, streaming live online all around the world at KBC.com, and the on-demand Mottek On Money podcast for you at KBC.com. Apple iTunes, all your favorite podcast platforms, and on the socials, too, at Frank Mottek on X, formerly known as Twitter, and Instagram. Stocks ending the day lower again today, with the S&P 500 sliding for the third day in a row as Treasury bond yields extended a sharp rise. Of course, that Fitch downgrade on Uncle Sam's credit rating weighing on things the last couple of days. And on top of that, the downgrade of mortgage giants Fannie Mae and Freddie Mac. Will that Fitch downgrade to break Washington's tax and spending habits? We'll discuss that tonight with the leading taxpayer advocate in the USA, Grover Norquist, the president of Americans for Tax Reform. Watching the price of oil bump higher again today. In fact, gaining more than 2%, up $2.05 back to $81.55 a barrel. We'll talk about what's happening with gas and oil prices tonight with one of the world's leading oil analysts, John KILDUFF, oil analyst at Again Capital and CNBC contributor. We're watching the earnings parade continue, with Apple coming in with earnings, seeing a slight fall in revenue in the latest quarter, and its management expects similar performance in the current period. We'll be taking a closer look at Apple's earnings news, as well as Apple stock. Looks like it's pulling back here in after-hours trading. In fact, let's get right to the latest action here. Joining us live now, investment expert BRYAN Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management. Also author of the 25% Cash Machine, a longtime contributor on Mottek On Money here in 790 KABC. BRYAN Perry, thank you very much for coming to the line here. A lot going on, of course, politics in the mix there with what's happening with President Trump. And our legal eagle, Royal Oaks, will be handling the 6 o'clock hour tonight. We'll be focusing on that. But take it from the top and give us your view of things here at the moment.
Thank you, Frank, and great to be with your audience as always here. We went from the Magnificent Seven to the Magnificent Sell-Off here yesterday, and that was really, obviously spurred on by this big pop in Treasury yields here after Fitch did cut the rating. That's, you've had people come out like Warren Buffett and Jamie Dimon here saying that not to worry. We know we're still in a good place. But it does drive the narrative in Washington and other places, or in the financial circles that are certainly, bent on trying to figure out, at what point is there a tipping point for the dollar and for interest rates and inflation and in managing our budget here at the congressional level. So that's a big macro issue. The market really more cares about the earnings issues of late here, and it's been a pretty good earnings season so far. You've got a big quarterly reporting season, where there's some big gains and there's also some big losses being witnessed by some of these stocks here. Today, Amazon really had a great beat, and Apple was just okay, not great. So you've seen some selling in Apple in the aftermarket here, but Amazon's up nicely. And for as far as these big caps go, it's been a good season for them. And in general, we've had a really strong sector participation here across the board. And the thing is, what I like about this market right now, even with this pullback here, I think this shakeout in the bond markets here are going to last maybe through Monday. It depends really a lot, heavily weighted tomorrow on the employment data, which is coming out before the market opens here, and whether that corroborates the the ADP report, which is a private payrolls report, which was that was much better than expected. Then we'll see what happens. Last month, the non-farm payroll data was tame against a hot private payroll number. So we'll see what happens there. But in the meantime, you've had some really great leadership stocks in all the different sectors here starting to participate here. In industrials, you've had Boeing and Caterpillar really have blowout numbers here. You've had J.P. Morgan and Goldman Sachs really lead the way for financials. Pepsi, Clorox, and consumers. In travel, you've had Marriott and Carnival Cruise. You've had Amazon and Wayfair had really solid numbers here for consumer discretion. Johnson & Johnson, United Healthcare have led the healthcare sector. Meta, Facebook, and Google have really led the communication services. You've had Cheniere and the Valero have led the energy sector here, much higher on wonderful numbers. And in tech alone, really, you've had in terms of AI, Adobe and Broadcom have really been stars in that particular sector. So it's been a very broad and very a well-represented rally up until this point. And there was a time we had a 14, 15-day rally there, so we were due for a pullback. But I think and when you get into these bull phases here, these pullbacks last usually 2-3 days, and then they tend to grab their, they get their footing. And I think that we're going to start to see that early next week here. And really, again, depends on economic data. But I like the price action here because a lot of these big names have come back to their 50-day moving averages here, and they offer investors a chance here to come into this market here. The big story going forward will be NVIDIA, which they will report their numbers on August 23rd, and that could mark kind of a near-term double top for the market here, where I've talked about maybe the market going into a period of consolidation here during the latter part of August and into September. And so I think that's really where we're going to have to continue to watch the inflation numbers. The Fed doesn't meet till the end of September, and it really is just going to be a market that's going to be consolidating and drifting. And normally markets drift lower; they don't drift higher in the late summer months. So we could see some back and filling, which I think is very structural and very good. And so it's going to give people a chance here to digest the gains and let the market here consolidate, basically relieve itself of this overbought condition and set itself up for a nice year-end rally.
We'll get to your stock picks shortly, or on the air live with investment expert BRYAN Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management. And BRYAN, let me ask you this. Maybe you can explain it in plain English with this Fitch downgrade of Uncle Sam's credit rating. We haven't seen anything like this since, 2011, when the S&P ratings agency downgraded the government's credit rating. And on top of the sovereign debt rating, we saw that Fitch also downgraded the credit rating for mortgage giants Fannie Mae and Freddie Mac. What does this mean in plain English to Mr. and Mrs. America?
Well, it just means that the long-term effects of all this debt that we're printing, now we're roughly at 120% of GDP. And it's just, whereas Japan is considerably higher, and we've seen that market's been in a bear market for many, many years. It's having a good year this year. But in general, what it means is that, there needs to be some big picture thinking in Washington here in terms of how this is going to be handled, because I think what Fitch is recognizing is that with interest rates here, short-term interest rates at 5% and change higher, and probably going to 6% by the time the Fed is finished, the cost to carry this interest on the national debt is just enormous. It's going to be arguably the largest line item in the federal budget in the next 3 years. And you just don't have that conviction in Washington at the congressional and senatorial level to really cut spending or manage the budget without having these one after another debt ceiling crises that come along. And so there really is no debt ceiling per se, because they continue to just raise it, to an infinite level here. And I think that this is really where Fitch and other rating agencies are starting to come into the reality is the cost to carry this burden of this debt needs to be shaken out, and it's going to have to come with some fiscal discipline. And without it, then I think that this is I think what should be a bipartisan issue and not something where Congress continues to haggle over spending, because the revenue is just simply, you've got to have a whole lot of prosperity in the economy for to raise those tax revenues to offset those spending increases. And you see these elected officials, they try to carve out their rationale, how they're going to save all this money down the road if they spend it now. That's not flying with the rating agencies. And Fitch is the first one to come to the fore and say, we're getting to a point here where it's going to start to matter. And I think that's we saw Janet Yellen and a lot of other people in the Biden administration really jump up and down and say, foul. And that's just but I think what they recognize is, the numbers don't always work out in the favor of those that say, well, we're going to go ahead. If we do all this, we're going to, be able to slash our budget here down the road. When in fact, we're spending a lot more money than we're making. And I think that's what most Americans understand when they sit at the kitchen table and look at their own budget. It's either we borrow and at higher rates, or we just cut spending and we become more responsible about our finances.
On the air live with BRYAN Perry, and maybe you can recall what happened back in 2011 during the Obama administration, the last time we saw a credit downgrade like this. What kind of market reaction did we see back then, and might that be informative here in this situation?
Yes, we did have a big pullback, and to the tune of, I believe it was around 7 to 8% for immediate reaction towards that. And that was, yesterday's was a very small reaction, but the market did recover and move higher and and regain itself, and obviously go to new highs. So, there's a knee-jerk reaction, and then there's people that that will come to the defense of what's taking place. In the administration here, which we saw yesterday. A lot of people were paraded out talking about how wonderful things are. And at the same time, interest rates back then were higher than they were today. But we're getting back to those levels here. And at the same time, even though we had a lower debt reduction, a rating reduction back then in 2011, we had a fraction of the debt that's outstanding now. This number out there, this $32 trillion, Frank, is enormous, and to really carve away at that, it's going to take an entire decade of real fiscal discipline to bring that back in line. And I think this is where Fitch and maybe Moody's and S&P, God forbid that they come in and do the same thing here, because that would really untangle the market here for a period of time. But it also might give a wake-up call to those in power that say, you don't want to kill the golden goose, which is the U.S. dollar. And in the process, that's what's at risk.
That is certainly something we're going to be watching very, very closely on the air live with Bryan Perry. And at this point, Bryan Perry, where are you putting money now and or taking it off the table?
Well, I think you can go back in here and look at the names here that have pulled back. I think that you can look at Amazon. Not Amazon here. That's already moved up higher in the aftermarket here. But I like Alphabet here on this pullback here. They had great numbers, so I like that here. Certainly, Microsoft on this pullback looks good here. I think you can buy NVIDIA in front of their numbers. I think they're going to have an enormously fabulous quarter, and because I think a lot of companies are just buying all they can. The hyperscalers are really loading up on their chips. On Semi, looks good. One of your big local bank there that owns the Rams, the stadium there, SoFi, they had great numbers here. The stock ran up to almost $12. It's pulled back to 10. Take a look. Freeport McMoran, copper. You need copper to make electric vehicles. Huge amounts of copper. And the housing market is still very, very robust on the new housing market here. And a lot of copper goes into construction here. Take a look at that. For consumers, I like consumables. I like Pepsi here. Pepsi had fabulous numbers here. That is pulled back. And in the building business, there, Trex, which makes your synthetic decking out there, TREX had great numbers here, pulling back. Again, this is the pause that refreshes here. So those stocks that gapped higher into the earnings reports and that are pulling back give you a chance to buy them when they fill those air pockets underneath. Coming off, big misses here by Chipotle, CMG, Shake Shack, SHAK, Live Nation, because it looks like there may be an antitrust suit coming after them to split up Ticketmaster and off of them. And then certainly the airlines I've been talking about that look like they're a little bit toppy here. Southwest, is still looking like there's a lot of bad memories of what happened to them last year. So those look like the stocks are in trouble here during this current pullback.
All right, and we're watching the media names. Looks like there's supposed to be some talking tomorrow between the striking unions, the WGA, SAG-AFTRA, and the producers, and let's see what happens if that in fact happens. But what about those beaten down media stocks? Are you watching those, and any thoughts about what's happening here?
Yeah, I've been watching them, but I'm not ready to do anything about it here because this is a very hot and very angry workforce that feels like. And we've talked about, it's very expensive to be living in L.A. and these other places where movies are made and a lot of content. So I think it's good to meet at the table, but I think it's probably going to extend itself out further because you've had some very, very, some strong positions on both sides of the table at work here, Frank. So, Disney's down here at 85.49 on the close today here. That's near a 52-week low. At some point, that makes sense. But again, it's just I'm just when you have until there's some daylight in these negotiations, Frank, I think you got to stay very careful here. Warner Brothers, same thing, that's been pulling back here. Sony, same thing here. So and Netflix is the only one that I think looks attractive here, and even then, but they missed some of their metrics here in their earnings report. The stock came down from 500 to nearly 430 here, but I think it looks like that's the one I would buy first. If I was going to buy into a media stock, it would be Netflix here at this level here. It's a key support level here, right on the 50-day line at 430.
All right, and what about Paramount Global, formerly known as CBS?
No, they missed their numbers again. And I don't know how they're doing on the streaming business here. It's hard to get a grip on. It seemed like they came out hot, and then the stock here has it struggles here. It had a horrible miss 1 quarter ago. The stock dropped from 24 down to 16, and here it's been trading sideways. And it looks like it may take out the low of the year, which is 13.80. It currently trades at 15. I would steer clear of that because the money flow in the stock is just hyper negative. And so you don't want to, you want to follow the money here. And I still see institutional fund flows moving out of the stock.
All right, and it should be noted, the reports indicate that it's the Alliance of Motion Picture and Television Producers and the Writers Guild that are heading back for talks reportedly tomorrow. Looks like SAG-AFTRA still waiting for some movement on getting back to the bargaining table, so we'll be watching that very, very closely. But getting back to that Fitch downgrade of Fannie and Freddie, might that also impact commercial real estate and make that already rather delicate sector even more vulnerable to another downturn? Brian, what do you see ahead there, and also the banks that are connected to what's going on in the commercial real estate sector?
Yeah, that's a very interesting question, Frank, and spot on, because in the last 2 or 3 months here, we've seen the Fed actually try to pump some money into the system here to help the regional banks, originate some loans here to the, to pump up their, their volume. And what we've seen actually is, which are C&I loans, those are commercial and industrial loans. The originations have actually come down. Not rapidly, but enough that it's meaningful, and those are important loans because those are the loans that they depend on the most for small to medium-sized businesses. So they're tightening lending standards here, and you're seeing the issue here now is when you've got rates moving up like this, and a lot of companies and commercial real estate companies that have to come and refinance the loans they've got out. Those buildings they've got, the loan to value that they bought back in 2014. Say you bought a $50 million building, now it's worth about $35 million. Then, to try to refinance that loan or extend the mortgage, then you've got your loan to value is much lower, sometimes 20, 30% lower, and then you're going to have to refinance that loan at much higher interest rates. So it's a real quandary here, and it's one of the things that the Fed doesn't talk about now. It's about $280 billion of that's being refinanced this year alone. Sounds like a lot of money, but in the big game of life, of finance, it's not. But in the next year or so, it's about, it approaches a 2-point-something trillion dollars. So it's a lot of money coming down the road here. So it's kind of next year's problem, Frank, if the Fed can't get interest rates back down. But I think this is really why I've been saying that the regional banks here, are, from here, are going to struggle going forward here because they still have the same problems they've got. People are still, if rates keep going up towards 6%, there's going to be another wave of deposit outflows into the online banks and into the brokerage firms that can, pay 5.25% on money market. So I think that your commercial real estate, you need to keep a finger on that pulse there because this is all, it's a grind lower, but it's not dramatic, but it's something that's going to probably come up in the fourth quarter of this year as a big issue that people are going to be, you can see a lot of tax loss selling in regional banks here at the end of the year.
Brian, thank you very much for that very thoughtful analysis and for the heads up on that important issue, which we'll be following here. Brian Perry, Chief Investment Strategist and Portfolio Manager at Mint Asset Management, and also author of the 25% Cash Machine. It's always great to speak with you, Brian. Thank you very much for taking the call here this evening.
Always good to be with you and your audience, Frank. Thanks so much.
Thank you very, very much, Brian. Brian Perry, folks, does your knee pain keep getting worse? How about that pain in your shoulder or hip or back? Don't let them tell you steroids or surgery are the only options. Take my advice now and call QC Kinetics. Frank Mottek here. QC Kinetics can make that pain go away with all natural, advanced regenerative medicine. They're helping people here every day with those amazing natural treatments that restore and repair your damaged joint tissue. It's like turning back the clock. Regenerative medicine uses concentrated healing agents from your very own body to stimulate that damaged tissue in your joints so they work like they're supposed to, and there's zero downtime. QC Kinetics is the nation's leader in this exciting medical breakthrough. Patients here are getting real, lasting relief and are saying no to surgery and drugs. If you have pain due to injury or arthritis, This is a remarkable option that you need to check out, and the consultation is absolutely free. Call QC Kinetics in Glendale, the city of Orange, Mission Viejo, and now also in Costa Mesa. The number to call is 213-997-PAIN. 213-997-PAIN. Again, that's 213-997-PAIN. 790 KBC welcomes Belinda Carlisle coming to the Libby Bowl August 24th. Tickets are on sale now at AXS.com. Right now, caller 9 wins at 1-888-790-5222. You can get a pair of tickets to the show if you're caller 9. Call right now, 1-888-790-5222, and good luck. Pullback for the stock market today with the Dow down 67 points at 35,216. The S&P 500 down 11.5 at 4502, and the Nasdaq pulling back 14 points at 13,960. This is a day after the Fitch Ratings Service downgraded the credit ratings for both Fannie and Freddie. Those are the two mortgage giants. That was a day after Fitch downgraded Uncle Sam's credit rating overall. Fitch's decision was criticized by, among others, former U.S. Treasury Secretary Larry Summers and J.P. Morgan Chase CEO Jamie Dimon, but yields have continued to push higher following the decision, with the 30-year Treasury yield on track to settle at its highest level since last November. The yield on the 10-year note, which impacts fixed-rate mortgage rates, has moved to 4.18%. Nervous time again in the mortgage business and, of course, real estate business as well. After the closing bell, Apple coming in with earnings. The stock closed down $1.41 to $191 and change, down about $4 in after-hours trading. NVIDIA shares today up about $2.50 at $4.95 and change. The price of oil, which we'll be talking about here, coming up shortly with John Kilduff, oil analyst at, again, Capital and CNBC contributor, moving up 20 cents right now at $81.75. Gold up $1.50 at $1,970. Taking a look at the cryptos now, we see Bitcoin up about $90 at $29,212. Ethereum down 6 at $1,837. Mottek On Money continues here in 790 KBC. Good evening. Uncle Sam's credit rating downgraded this week for the first time since 2011. The Fitch Ratings Agency also downgrading the credit rating for mortgage giants Fannie and Freddie. Will this Fitch downgrade break Washington's tax and spending habits? Well, we're watching it. The decision by Fitch Ratings to downgrade the U.S. credit rating continuing to impact both treasuries and stocks. Today, it's complicating investors' feelings about Treasury debt, just as the Treasury is preparing to issue another $1 trillion in new debt during the third quarter. Let's bring in the expert on all this, Grover Norquist, president of Americans for Tax Reform. Meanwhile, the IRS making news, saying it's planning to go paperless for tax preparation by 2025. Grover Norquist, thank you very much for taking the call. First, on the bombshell news about the credit rating downgrade for Uncle Sam, give us your reaction and what this means to you, me, and everyone out there, the taxpayers.
Well, it could mean that the government, you and I, as taxpayers, have to pay more higher interest rates if the government is seen as a less good risk. I'm not sure what's happened that would guarantee that. It does seem to me they're alone here. Is it true that our credit rating should be somewhat problematic? Yeah, except the government's ability to take money in taxes is pretty absolute. The problem we have in spending is a long-term one. It's not going to show up in the next, in terms of inability to pay for our debt in the near future. So I'm not quite sure what it means, but I guess it's a shot across the bow. I do wonder why one, creditor did it, not credit rating people did it, and not others. We should be concerned about the level of spending, about the runaway spending, which is attached to pensions, which just get bigger and bigger, and the tax increase, the spending increases from entitlements, which Congress never votes on because they're just automatic pilot. I mean, that is a problem that continues and will continue. And I guess if this reminds us about that, it's helpful, but I don't know that it's going to change anybody's mind. I do hope some people will say, let's go raise taxes to solve all the problems. That's the way Argentina solved its problems.
Yeah, and look what happened there. So is this coming to a boil now? Is shot across the bow and all that? We've heard these various expressions. At what
Yeah.
point does the debt become an issue? Remember last time it seemed to be a big issue when Ross Perot said in order to fix a problem, you got to open the hood. Did somebody suddenly open the hood there in Washington again?
I don't know why a credit rating person would do this now unless they're advertising their credit ratings to get some name ID. I don't see something that happened just now as opposed to 3 years ago or 3 years from now. So it's a very good question as to what they think they were pointing to. I think it's probably a good idea for everybody. If somebody thinks they see it, remember people didn't see it in 2007, 2008, 2009. Let's all take a good look at some of the extended loans from Freddie and Fannie. When we had that crisis, Freddie and Fannie Mae, which guaranteed loans, and then were backed by the government, even though everybody said they weren't really, they actually were. The regulations that flowed from that regulated everybody except Fannie and Freddie. So it's entirely possible they didn't fix the problem, which was Fannie and Freddie's bad loans, knowingly bad loans, and so this could could blow up again.
Yeah, very interesting. I remember when the government took over the mortgage giants Fannie and Freddie. This was after the head of the St. Louis Fed at that time basically said that they were insolvent. And I remember speaking with them on the air that day. He spoke to my show and also Bloomberg, and the rest is history. But something's going on.
Yes, and I think everybody should take a serious look at it, and hopefully it can scare some people straight. But this has been they keep turning the water up and the frog's in, and it's getting about ready to boil, and you never quite know at what point it actually does.
All right. In the meantime, it looks like the government needs more money, right? So in comes the IRS. Their unofficial slogan is "We've got what it takes to take what you've got," and it looks like you're going to be going electronic, right? At least that's the plan in the next couple of years. Tell us about that.
Well, that's less scary to me, other than some people are much more comfortable using paper. You will have to, if you're not skilled at the computer, you may have to go and pay somebody to help put it in the computer for you. But many people will be able to do that fine. Taking away the option of doing it on paper will certainly make it a lot easier for them to function, or the IRS to function. It does raise questions of privacy. One of the problems we have in privacy is the reason why ProPublica, the left-wing group, was able to get stolen documents, stolen IRS audits and IRS filings, was that somebody could sweep through all of the electronic ones. Then you got all the billionaires, basically, and then they knew what they were looking for, and those aren't kept in one place except on the computer, right? If you had to go steal the paper returns, you couldn't get thousands and tens of thousands of them. So the danger of somebody at the IRS cooperating with a left-wing outside group to steal and make public people's tax returns, to use them to blackmail people and so on, that's a bigger problem when it's not on paper, because on paper you can't take thousands of people's tax returns out of the office in your suitcase without being noticed. You can do it with a click of a button, so that's going to be a problem. And they haven't even tried to find the guys who did this other one. I mean, I just really they have earned our distrust on their capacity to keep people's IRS material private, and making it all on the computer makes it too much easier with a press of a button to steal it all.
Interesting write-up about how the president's son blew off the IRS while making millions. The allegation here is that he willfully failed to pay federal income taxes for 2017 and 2018, and it looks like this legal matter is still being decided. But what are your impressions of the Hunter Biden tax situation here?
It is so wrong on so many levels. President Biden, as a candidate, said if you didn't want to pay more in taxes, you weren't patriotic, and it was patriotic to pay taxes. and just saying other people who didn't want to have more of their money taken from them, that there was something wrong with them wanting to keep the money they earned. And then he's got a son who he was in business with, or at least took calls with the people he did business with. And just to let you know, the vice president takes the kid's calls. If you want to influence the vice president, he just proved that he could get the vice president on the phone, which is what those 20 calls were that Biden was listening to with the guys that were hiring him as the lobbyist and so on. His son was not paying taxes for a long time, a lot of money, a lot of income not paid. People are in prison today for a lot less, much less on the tax fraud part. Never mind the questions of the international regulation of being an international lobbyist for another country, Foreign Agents Registration Act. They were trying to, the defense said, we'd like to not go to jail. We'd like you to slap us on the hand and say we were bad here. And then we want to be protected from prosecution for a whole series of FARA, right, telling you that if you illegally lobbied for a foreign client that you didn't report to the government, which is a go to jail for 18-year thing, why in the world would you hide who your clients are unless there was a real dishonest reason? Why would he feel that you wanted protection against being charged with FARA violations, Foreign Agents Registration Act violations? What did they do that they don't want to go to jail for? It raises all sorts of questions. And why, when you cut a deal with the IRS, should this other thing be attached? Where'd that come from?
Yeah.
This just really smells. Nobody gets deals like this. Nobody.
Maybe that's why they're bringing in 87,000 agents to try to figure all this out. Grover, thank you very much for joining us live here tonight, right? Grover Norquist, President of Americans for Tax Reform, live with us here tonight. Mottek On Money on 790 KABC. Folks, you've heard me talk about my friend attorney Clark Fielding for a very long time. Clark Fielding has my trust, and I want you to feel comfortable when you call him. Clark Fielding and all the good people at Fielding Law are the best choice for personal injury representation. Clark Fielding will go the extra mile to help you deal with any injuries, and of course, the insurance companies, which are not on your side. It's jarring to have a car accident, hard to think clearly when you're hurt. So Clark Fielding has created something to help us all. It's a guide called Be Prepared Before a Motor Vehicle Accident. Go to clarkthesharklaw.com and download the free one-page guide. Keep it right there in your glove compartment. Put Clark Fielding's number in your phone, too, under the word accident. So all you have to do is dial the number when you need him. Tell your family and friends to do the same. So if you're hurt in an accident, call the one we all trust, Clark Fielding. The number is 833-88-SHARK, 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 and download the Be Prepared Before a Motor Vehicle Accident Guide at clarkthesharklaw.com. Again, that's clarkthesharklaw.com. Mottek On Money continues here in 790 KBC. More pain at the pump here in Southern California these days. A big jump lately. In case you hadn't noticed, $5.13 now the average price for regular gas in the LA Long Beach area. Premium back up to make that $5.46 a gallon. $5.46 a gallon. The average price for premium diesel now at $5.52 a gallon on average. This as the price of oil dances above $81 a barrel here at the moment. Let's find out what's happening now with John KILDUFF, veteran oil analyst and managing director at Again Capital, also CNBC contributor and longtime contributor, decades-long contributor here on this program. John KILDUFF, thank you very much for taking the call here. John, it's been a while since we've chatted behind live microphones, so give us an update on what's happening to cause this latest spike in gas prices and what's happening with the price of oil.
Well, I certainly am proud to be a decades-long contributor to your program, Frank. So thank you.
Thank you.
Look, there's a couple of things going on. One of the issues is that this extreme heat in the South, I do want to point this out, is affecting refinery operations to a degree. Not a big degree, but enough to sort of pinch supplies and push prices up. But the big news today, and the big news of the past several months, is that Saudi Arabia is on a path to push oil prices up really like I've never seen before in my career, and almost harkens back to the OPEC embargo days of the 1973 era, because, they are under incredible pressure. When we talk about their break-even point for producing oil, it's in the single digits. Okay, it's like sticking a straw on the ground for them and sucking the oil or the water out of the ground. But they have these grandiose dreams right now by their new young Crown Prince Mohammed bin Salman, who's building this new thing in the desert that really has raised their fiscal. We talk about the government and the budget. Their fiscal break even is upwards of $80 a barrel. So the Saudis really need $90 to $100 a barrel to do what they want to do. So they are acting in that regard in their own best interest, and they're taking it not only to the U.S., but to Europe and even their customers in Asia, including China. They want a higher price for oil. They announced today that they're going to continue to withhold over 1 million barrels a day of their own production voluntarily now throughout September. Most of us in the market expect them to continue to do that into October, November, December. And the fourth quarter of the year into the new year is the peak demand period for crude oil. So if they do stick to their guns on this, we all could be in for a lot of pain at the pump.
That is so unfortunate. And of course, John, in more recent years, we didn't talk about the Saudis that much because we were producing enough of our own oil here. And by the way, 100 years ago, California accounted for 25% of global oil production. It's hard to believe that was the case, but that is the situation here now. And now with the refinery issues here reported again in California and the issues that you just raised with oil hovering near $82 a barrel now, we've got gas prices well above $5 a gallon here now for regular and for premium as well as for diesel. What is the situation here now for drivers in California?
Well, in California, I mean, you guys keep shooting yourselves in the foot, or the leaders do, in terms of, putting pressure on the refiners there. And they're dwindling, it feels like, by the day or by the year. And it's a problem. I mean, obviously, people have this fantasy that there's EV adoption and all that. And in California, I know it's aggressive and folks are into it, and, God bless them. But look, the bottom line is that we are still going to need fossil fuels for a long time to come. And to the extent that we're damaging that production, and you're right, Frank, the California production is meaningful. The California refineries output, that what's left of it, is meaningful. It's only going to get worse. But what I'll tell you, though, is that what's amazing is that the problem the Saudis have is that last week, according to the U.S. Energy Information data, the U.S. exported 5 million barrels plus per day of crude oil. So now the Saudis are down to 7 because they're trying to curtail. But all of a sudden, they're looking over their shoulder, and U.S. shale producers and U.S. pipeline operators and U.S. and international tankers are taking our crude and sort of offsetting that Saudi situation. So it's not a clear run to $100 a barrel right now, in my opinion, because of U.S. We talk about U.S. independence. We could be talking about U.S. dominance in the global energy market because of the ingenuity and the innovation and the strength of the companies from ExxonMobil all the way down to Pioneer and Cheniere.
Very interesting. In the meantime, drivers here in Los Angeles are paying higher than they're paying in Hawaii, which is in the middle of the Pacific Ocean somehow. So we're all scratching our heads here as to why that is the case.
And that's because, Frank, we've talked about this before. First of all, California, your California Air Resources Board gasoline makes it so that we can't really, the other states can't export, if you will, supplies into California. It's got to be made there. There's severe restrictions on the refiners. Again, this is a policy thing. And I guess you can laud it if you're, worried about the environment and all that kind of thing. But, to the extent you're worried about your economy, and like you just talked about, people need to drive to work. In California, there's not a whole lot of mass transportation out there where you guys are. So this is all policy driven. It's all, from the state, local, policy driven. They've pressured and got refineries to close. They've gotten some refineries to, quote unquote, switch over to biofuels, which has turned out to be a disaster. It's just a complete disaster.
John, thank you very much for that important update tonight. I have a feeling we'll be talking more often with the price of crude up around $82 a barrel here in the U.S. and above 85 now in Europe. Thank you very much, John KILDUFF, for joining us live here tonight. Oil analyst at Again Capital, CNBC contributor, and great contributor here to Mottek On Money on 790 KBC. We'll be back again tomorrow evening at 5 o'clock. You can also bring up the Mottek On Money podcast on demand at KBC.com. Stay tuned for the 790 KBC News Blitz coming your way next. This is Mottek On Money on 790 KBC.